let's take an example on a contract that includes significant financing component, assuming that the customer is going to pay in arrears. So the customer is going to pay later on after the delivery of the product and the services. Recalling on the first example, we explained what if the customer is going to pay in advance. So if the customer is going to pay in advance, the company effectively is borrowing from the customer. And in this case, we recognize financing cost. This was in the first example. In the second example that I'm going to explain now, the customer is going to pay in arrears. So the company should recognize interest income or financing income, and this will be separately reported in the financial statements separately from the revenue from the product and the services. Let's see the example and let's explain the accounting entries that we have. On 1st of May 2018, company B enters into a contract with a customer to sell property A. So the contract inception is the beginning of May. Control over the property A passes to the customer on 1st of July when the keys are handed over. So now the customer took over the control and received the property on 1st of July. Selling price is 4,494,400 payable on 30th of June 2020, I mean. So now the customer is going to receive the property in 2018, and the customer is going to pay the company after 2 years. So this is the meaning of payment in arrears, that the customer is going to pay later on after the delivery of the product and services. Had the customer paid for the building on 1st of July, so if the customer is going to pay us on the spot and the same time of receiving the property, the consideration would be 4 million. So the price should be 4 million. So this will be the cash selling price, assuming that the customer is going to pay us today in the same date of receiving the property. The rate, the discount of the deferred consideration. So this 4,494,000 is called deferred consideration because the customer is going to pay after 2 years. The rate, the discount, the deferred consideration 4,494,000 to the cash price, which is 4 million, is 6%. So 6%, this is the discount rate that the company is going to use, and this is called also implicit rate in the contract. This is the rate that make all of the future cash flow, which is 4,494,000, equal to the cash selling price as of today. So if you discounted all of the future cash flow to the 4 million, the result will be 6%. This will be the discount rate, and this is what actually we are going to use in order to recognize the financing income, as we are going to see now. Let's analyze the case. The first question that we need to answer is this contract include a significant financing component? The answer is yes. Why? Actually, because the customer is going to receive the product today and is going to pay after 2 years. As long as it's more than 1 year, and as long as it is a long period like that, so this will be the contract will include a significant financing component. Okay. Now the discount rate that we are going to use is 6%, and effectively the company is giving loan to the customer. Effectively, the company is providing finance to the customer, because the customer is going to pay later on, and because the company is providing finance to the customer, so the company must recognize interest income or financing income today. The first stage of the interest is at the time of the inception of the contract, the time of the transfer of the product and services to the customer, which is on July, 1st of July. Control of the property have passed to the customer, so the first entry will be on July. Okay. Now, according to the 5 steps model, the company should recognize revenue as per step number 5 when the control of the product or service transferred to the customer. So in July, the company transferred to the control to the customer, so we need to recognize revenue on July, regardless you collected the cash or not. So we need here to recognize revenue. So we are going to say credit revenue with how much value? The value of the cash selling price as of today, which is how much? It will be 4 million. So this will be the value of the revenue that you need to recognize today. Because remember, in the beginning of the video, I explained that the revenue, if your contract includes significant financing component, so your revenue should reflect the cash selling price at the same time of delivery of the product and the services. And because the company delivered the product on July, how much is the cash selling price on July? It's 4 million. And this will be recognized as a receivable from the customers, because the customer didn't pay us on July. So this will be receivables. So it will be contract receivables. Contract receivables. Okay, so this will be with the same value, 4 million. Okay, now let's go for this, the first year, end of first year. So the first year already finished خلاص, and we need to record the journal entry, because effectively the company is giving finance to the customer, so the company should reflect or should record finance income. So the company should record finance income. So in the credit here, I am going to say finance income. How much is it? How much is it? We are going to say, okay, it is 4 million times the 6% that is stated in the case study here, and this is the discount rate that the company is going to use. Because the company is going to recognize finance income, and the company didn't receive yet the cash from the customer, so we are going to increase the receivables. So the debit will be the contract receivables, so it will be the same contract receivables here, so it will be the same value of 240,000. End of the second year, we need to redo again the same entry to recognize finance income, and because the customer again didn't pay us yet, so we need to increase the receivables. So we are going to repeat again the same entry. So we are going to say this one, we are going to say finance income equal to the ending balance of the receivables. So let's calculate here the balance of the receivables, balance of the contract receivable. It will be how much? It will be 4 million plus the 240,000. So it will be 4,240,000. So we are going to say this is the ending balance of the first year, and this will be the base that I'm going to calculate my finance income on. So I'm going to multiply this by the 6%. So the finance income in this case in the second year is 254,000. This is the finance income on the second year. Again, calculated based on the ending balance of the previous year. Ending balance of the previous year, which is the first year, is 4,240,000, and this is the finance income. Okay, clear. Now this will be debited to the contract receivables because I still didn't receive any cash from the customer. So I am going to say debit the same amount to the contract receivables. Okay, clear, perfect, perfect. Okay, at the end of the second year, again on the same day, the customer is going to pay us cash. So we are going to receive cash from the customer. So we are going to receive cash. How much cash we are going to receive? You remember the customer is going to pay us 4,494,000. So we are going to say 4,494,000 and 400. Okay? Okay, so this will be the cash that I'm going to collect from the customer. How much the ending balance of the contract receivables at the end of the second year? At the end of the first year, it was 4,240,000, and you increased receivables or finance income for the second year by 254,000. So the result will be the same value of the cash that the customer is going to pay you at the end of the second year. And this is the magic in accounting, that the process of calculating the financing income will make the beginning balance at the first day of the recognition of the revenue equal at the end of the second year to the same amount that the customer is going to pay you. This is the magic of the accounting. So the same value here will be credited to the contract receivable. And this will be the same value in order to close the contract receivable. So contract receivable after posting this entry will be 0, and you collected the cash from the customers and you recognized revenue when you deliver the product to the customer. So everything in accounting has been done so far. Now, what will be the reflection on or the impact on the financial statements on these 2 years? Let's recall back the process from the beginning. At the beginning, when you deliver the product to the services and the service to the customer, you recognized revenue. So you recognized revenue 2 years back. Then every year you recognize financing income. On how much you recognize revenue? On 4 million. And this financing income, it is not a revenue, it is other income or financing income. It's separately reported from the revenue. You cannot report this finance income as part of the regular revenue in your financial statements. This must be separately reported in the financial statements. So the finance income for the first year, which is 240, and for the second year, which is 254, this is the must be reported separately in the financial statements. At the end of the second year, you have to close your contract receivables with the cash that you are going to receive from the customers. I hope the explanation of the contract, which includes significant financing components, is helpful. And if you have any comments, if you have any questions, please let me know. Thank you. Assalamu alaikum.